All right. Hey, everybody. Welcome back to Financial Coaching Round 2. Last time we talked about budgeting, and I sent you a form, and hopefully that was helpful to you. If you have any questions on that, please let me know how I can be of help. Today, I want to just do a quick little session with you on the topic of investing and saving for the future and wisdom in that. You know, a lot of people don't think about investing or saving for the future until it's too late. And that's why in today's society, there's so many people who simply don't have enough and have to work way into their older age simply because they unfortunately failed to plan early enough, and therefore eventually it caught up with them. I found that a lot of times people don't save or they don't invest for the future because, number one, they don't think about it. They don't think that it will ever apply to them or that they'll ever need it. And so they just simply don't. Second reason why people don't invest is they think that they have time. They think that they have time. And so, I won't do it this time. I won't do it this year. I'll wait till next year. And that happens perpetually until eventually it's 30 years down the road and they haven't started investing and saving for the future. The third reason why people don't invest or save for the future oftentimes is because they're confused by it. They've never had somebody talk to them about some of the different options and what those options mean. And so in the confusion, they simply decide, I'm just not going to worry about it. It's too intimidating for me. I want to dispel some of that today, and I want to help you out and set you up so that you can win when it comes to investing for your future. So let's get right into it. I'm going to show you some of the different ways to invest, some of the different tools that are out there. And hopefully this will get you pointed in the right direction, and then you can make some decisions from there. So let me go ahead and share my screen with you and want to show you this wonderful little thing right here. So I'm going to make this nice and big so that you can see it full screen. Okay. And I'm going to make this a little bigger. So this is going to be our little guide that we're going to walk through. And I'm going to give you the method for investing or saving. And I'm going to give you the description of the tool, the risk of it, whether it's high risk, low risk, and then the strengths and weaknesses of each one. And then if you have specific questions, please feel free to reach out to me through calling, text, or email. All right, let's start with number one, money market account. Money market accounts are a great way to save for the future. A great way to save, especially in money markets, really good when it comes to your emergency fund, like we talked about last week. You should always have about 3 to 6 months of expenses in a savings account that you don't touch. A money market account is a great way to do that. So money market account, what is it? Well, a money market account is a savings account, typically at a bank, and it has a little bit of a higher interest rate, and also allows for check writing privileges. So the interest rate meaning that when you put your money in a bank, they will tell you, hey, listen, if you put your money here, you could earn up to X% interest on that money. And oftentimes in today's society, the interest rates are pretty low, but in a money market type account, your interest rate might be a little bit higher. Not something amazingly overwhelming, but that's okay because this money you want to be able to have access to quickly in case of an emergency or something like that. So a money market's a great tool for saving. The risk is very low, very low, because you're not going to lose anything. You're not going to lose any money. The best thing is that you get a little bit of interest growth on it, but that money's not going to go anywhere. The strengths of this are this: because of the low risk, it gives you peace of mind for stability. That's why I think that money markets are great tools for emergency funds. It's easy access. That's another great thing. So if something happens on your car, or you have an issue that comes up that was unforeseen, you don't have to go through a lot of hoops. It's accessible and available for you. And like I said, another strength is it's great for the emergency fund. What are the weaknesses about this type of investing or savings tool? It doesn't yield a high return on interest over time, but that's kind of a weakness of it. But then again, that's not necessarily the point of that investment as well. This is really that's less investing and more saving for a rainy day. That's a money market account. Let's go down to the next one, certificates of deposit. The common term for this is CDs. You may have heard somebody say, yeah, I've got my money in CDs. CDs at one point back in time used to be a pretty decent way to invest your money. because the interest rates were higher. But today, CDs, to be honest with you, not the greatest long-term investment strategy because the interest rates are so low. I remember at one point that at a bank that I was at, if you guaranteed that your money sat in the CD account for like 2 years, you would earn 1.5% interest. That's just terrible return of investment. So here's what a CD is, a certificate of deposit is basically this. It's a savings account at a bank where the bank guarantees a certain interest on that money if you guarantee that you're going to keep it in there for a specified period of time. So there are 6-month CDs, 12-month CDs, 24-month CDs. I think I've even heard of a 60-month, like a 5-year CD, where you say, listen, I'm going to put this $1,000 into this CD and it's going to sit there and it's going to stay there. And then the bank says, okay, if you leave it there for 6 months, at the end of 6 months, it's going to have this much interest that it will increase by. So that's what a CD is. It's very low risk. You're not going to lose anything on a CD. You're not going to lose anything. It's a very, very low risk situation. So here's the strengths of a CD. There is a guarantee for some interest growth. That's a good thing. That's a strength. And again, like I said, another strength of it is that your investment, you're not going to lose your money in the investment. But I would say there's some significant weaknesses when it comes to a certificate of deposit or a CD. The first one is this, is that your money is tied up and it can't be accessed without penalties. So if you commit to put $1,000 in a 6-month CD, you cannot touch that money for 6 months. If you do decide that you need it or something comes up and you pull it out, you actually pay penalties for pulling it out of that CD. That's not what you want. That's not a great reward for having your money tied up for a long time. And secondly, like I said earlier, typically the interest return is very, very low. Now, if you are in a situation where you can find a higher interest rate, that it might be something worth considering potentially, but for the most part, these days, CDs, maybe not the best long-term strategy for growing your money. But those are what CDs are. Second type of investment is an individual stock. So individual stocks, you've probably heard of people who buy or trade stock or sell stock. Maybe you even work for a company that allows you to buy stock in the company. Stock is the purchase of a shared interest in a company. When I worked at Starbucks, one of the benefits for us as an employee is that we could buy stock at a discounted rate with the company. So, I would buy 20 shares of stock and I would have an investment in Starbucks. And then as the company grew and the company became worth more and the shares of stock became worth more, well, then the money that I invested would grow. And it was a way that you, over time, invest your money. So individual stocks on the risk scale, these are a little more risky. Definitely more risky, especially because if your money is in one individual company, then whatever happens with that company, your money is tied up in. So it can prove very fruitful if the company does really, really well. But if that company does really, really bad, you could literally lose all of your money. Think about back in 2008 and 2009, people who had their money tied up in companies like Enron, overnight, their stock went to nothing. So you could really lose your money big time if you're investing in just one company. But here are some of the strengths. The strengths of stocks is that it's a great opportunity for interest gains because you're typically going to get a higher percentage of interest return on stocks than you will on, let's say, like a CD. Also, it's a diversified way to invest. So it's your money's not in a bank, it's in a company. And so as that company moves and grows and changes, it's a different way to diversify your portfolio. Here are some of the weaknesses with individual stocks. And I've kind of mentioned them before. High risk of downturn on an investment. If that company does really bad one year or they have a product that gets released that causes harm in the marketplace, you're in big, big trouble and could lose a big portion of, if not all of your money, if it's all in one company. With stocks, weakness of stocks is that growth is not guaranteed. There is no guarantee that what you put in, you're going to get out. You could put in a little bit and get back a lot. That's a great thing. You could put in a lot and get back very little. It's just the nature of the market. And another weakness is that I put down here, entire investment could be lost. Like I just said, not so great. But doesn't mean that you shouldn't experiment with it. Doesn't mean that you shouldn't look into it. So that's individual stocks. The next investment strategy is bonds. You maybe have heard of people who purchase bonds. So here's what a bond is. A bond is loan money that's paid back with interest over time. So there's things called government bonds, where the government issues these bonds. People pay for the bonds. The government will use that money and then pay it back with interest. Bonds are typically moderate risk. Bonds, or companies might issue bonds. These are moderate risk. The way that you would lose all the money is if the company's not able to pay the money back, which would be a big bummer. But it's not so much a high risk as it is a moderate risk. Here's some of the advantages of a bond. More guarantee of interest growth. Again, you're probably going to get a way higher percentage than you would at a bank if you put your money in like a CD. And it's a safer long-term investment. In fact, we've got some money in bonds that is pretty accessible, and the likelihood that we would lose all of that money is pretty low. So it's a fairly safe long-term investment. You're not going to make a lot of gains in the short term, but over the long term, you could do fairly well with it. Here's some of the weaknesses of bonds. Growth can take a very long time. It can take a very, very long time for you to see a lot of increase because it just takes a while. Second weakness is that the interest rate might not be worth the time invested. So you may get paid back for your money with interest, but the interest rate might be so small, bigger than a bank maybe, but not so big that, if you left your money in for 10 years and you only yielded like a 2 to 3% interest rate, you could probably do better than that in a different kind of product. Mutual funds. Mutual funds are probably one of my favorites, and probably a favorite among people who invest. So mutual funds are the purchase of a group of individual stocks. So there's these things out there called mutual funds. And basically what it is it's these, we'll just think of it like a bag that has a bunch of individual stocks inside of it. So you have, let's say this bag is called Big Business, and you have stocks like Walmart and Costco and Facebook and Apple, all these big companies. You have individual stocks, but you buy them all as one big mutual fund. That's what a mutual fund is. And within mutual funds, there's all different kinds. There's tech mutual funds. There's foreign company mutual funds. There's small business mutual funds. There's large business mutual funds, all different kinds of things, medical even. These can be moderate to high risk depending on what type of fund you invest in. Typically, when you go to purchase, it will tell you, hey, this is a high risk, or it'll say, no, this is more of a low risk. So you can play with that depending. Here's what the strengths are about mutual funds. It's a great opportunity for long-term income growth at a higher interest rate. Typically, what you'll find is that in mutual funds, there's a lot of them out there that have been around for a very long time. And so you can look at the track record over a period of many, many years, sometimes decades, to see, okay, what is the trend of this? And you might have a fund that averages 11% growth. That's huge. What that's saying is that if you put your money in this, the average growth is 11% over time, over a period of time. That's a big, big deal. The other advantage with mutual funds is it's less chance for massive decrease. Unless the market as a whole shifts, if you have a big pocket of a lot of different companies, if one company goes bad, well, you've got all these other companies in there. And so one company going bad is not going to affect your entire portfolio. So what are the weaknesses of this? Substantial growth can take a long time. These are investments that are for the long haul, not for trying to make money overnight. And again, growth is not guaranteed. When you invest in stocks and mutual funds, it's not guaranteed what tomorrow will hold. It's a risk you've got to be willing to take. The final one that I'm going to get to before I get to some of the other things I'm going to talk about before we wrap up is real estate. Real estate can be an amazing way to invest your money. And real estate is simply the purchase or ownership of real property, okay? It can be land, it could be a house, it could be condos, it could be apartment buildings, it could be duplexes, triplexes, fourplexes, eightplexes, whatever it is. It's the ownership, or even just the house that you live in. It's the ownership of real property. Again, real estate can be a moderate to high risk depending on what type of property, what you're going to be doing with it. If you're, buying in a certain part of town, if you're trying to do fix and flips, all of those things have varying degrees of risk associated with them. Here's some advantages of real estate though. Overall, it's a strong overall investment for the long term. The trends over time show that real estate tends to always be a way for your money to grow. Real estate overall, it moves up. Another thing about real estate that's good is that typically with real estate, it's a physical asset. Therefore, it tends to guarantee some kind of return. So even if the market goes down, you still have an asset, you still have the house, and it still can be worth something. And finally, supply and demand. This is another strength with real estate. There's always going to be a demand for people to live in houses. Unless society changes and we decide to live in tents, people are always going to want to live in places. And so it's a great opportunity for you to invest in something that doesn't seem to be going away anytime soon. What are some weaknesses about real estate? Well, real estate can be very expensive to maintain, obviously. When the house has issues, you've got to fix it up. When something goes bad, you can't just let it go. So it can be an expensive thing to maintain. Another thing is that another weakness of it is that it can be a large initial cost. Purchasing of property, it's one of the most expensive things, if not the most expensive thing you'll put your money into. And so getting started can take a lot of money. And then finally, sometimes the weakness can be is that you can have too much exposure if you're overfinanced. There's not a lot of people who have millions of dollars laying around that they can just go buy property and that kind of a thing in cash. And so some people, what they'll do is they'll leverage some loans or some debt in order to purchase property. And that's not always the most wise way to go about it. And you can get yourself into big trouble if you're overexposed in that sense. So those are just some simple, hopefully tips for you on how to invest. And my goal with that was to just kind of explain some of these different things. And if you have specific questions, please let me know. Finally, I'm going to wrap up by talking with you about 3 common methods that you can use in order to invest in different kinds of ways for your future. So there's a 401k. Sometimes your workplace will offer this. 401ks are pre-taxed investments. So you get paid, and then before tax is taken out, you can put money into a 401k, and it sits in this account and it grows and it grows. You can access it when you're 59 and a half or after for no penalties. So it's a great way to build money over time. It's typically set up by an employer, and sometimes your employer will even contribute into it, which is really, really nice. It's a great benefit. And when you're 59 and a half or over, when you receive the money, then you pay taxes on it. That's a 401k. A 403b is literally almost the exact same thing as a 401k. It's just for nonprofit organizations. So as you'll notice here in the description, it's almost the same thing. And then a Roth IRA. I'm going to talk about Roth IRAs are really, really great investment tools. So these are post-tax investment strategies. So if you have a Roth IRA, you put money into that after your taxes have been taken out. And that money sits in there and it grows and it grows and it grows. And then at 59 and a half, you can access that money. But since you already paid taxes on it, you don't have to pay taxes again on it. Really, really good deal. Another interesting thing about the Roth IRA is that any money that you have invested into it, you can take out with no penalties. The only penalty you get is if you take out the growth. So if I put $1,000 into a Roth IRA, let's say that it grew by 5%, okay? Now, let's say that I needed to get into that money for some reason. Well, I could take up to $1,000 that I put in without any penalties, but if I access that 5%, I'd get some penalties on it. Roth IRAs, they're just great tools. It's a great way to avoid taxes down the road. So hopefully that was helpful to you guys. I'm going to send this little guide out to you in your email so that you'll have this. And my hope is that some of this was cleared up for you. If you have questions on how to invest or where you go to even do this kind of stuff, reach out to me. I'd love to help you. And hopefully this will help you understand better and help you win when it comes to your investments. All right. So hope you have an awesome rest of your day. I will talk to you later. Goodbye.